And this is like the absurdity of it all. Like if you actually break it down, and it's a hard topic to get into, in a way that, like, I feel like I know what I'm saying, but I feel like I'm not
able to explain
it very well. It's like, okay, I mean, everyone's probably heard of that whole conspiracy theory about like banks creating money out of nothing and that sort of thing. It gets a lot of points right. Mm-hmm. It's a shame it then goes off on a big tangent and says the world is owned by like lizardmen or whatever.
Right.
Like the fundamental.
What's the conspiracy theory? What's the theory?
So this is like the whole the New World Order thing. So like the Illuminati own the world. They created the Federal Reserve in 1913 on Jekyll Island, and they basically print money out of nothing. And the Federal Reserve's privately owned.
Isn't the Federal Reserve privately owned though? Isn't it like a weird thing where it's not actually a government entity in the U.S.?
I believe so. Yeah, it is. But people, like when a bank lends money, because banks do create money. But they do it by way of lending on deposits. So like if you deposit $1,000 into a bank, say, they in the olden days would pay you interest rate on that. Now it might be like 0.1% interest or something. But the way that they're able to pay that interest to you is by lending that money to somebody else.
But hypothetically, that should be the same interest on yours, right? Like the 1-to-1.
So the bank basically takes the difference. So there's like a margin there. So like say they lend out at 4% and they pay 2.5% on the term deposit.
Sure.
That 1.5% difference will be the bank's margin.
Right.
But the thing is, you could go into the bank tomorrow and take that money out, right? But that's already been lent to someone else.
Sure.
So,
and what happens if everybody wants to take their money out? And this is where the banks were collapsing, right?
And that's more where the bank run happens. Yeah.
Yeah. And then even more so in 2008, where people were actually trading on money they didn't have either. So it wasn't even a lending issue. It was more just like a speculative investment kind of issue, right?
Yeah. So 2008, there's like a lot of what they call like stock options, like derivatives. And a derivative, in like a very simplistic way, it's like saying, in 2 months, say you run a big oil company. It's a good example because oil went to negative. So like 2 months time, I'm going to need a whole shipment of oil for my company to continue running. So if you think the price of oil is going to go up in 2 months time, you can put an option, which is basically, I will buy the oil in 2 months time for this price, and I can take delivery of it. So say the price of oil today is like $200, and in 2 months time, the price of oil becomes $400. If you buy it at today's price for delivery in 2 months, you're going to make a profit of $200 per barrel. And I mean, that's not what oil costs, but just an example. If the price goes down, then you're going to have lost money on that option. So what happened in 2008 is, instead of that being used for like a supply chain reason, people trade these just like they trade stocks, bonds, whatever. And so big companies were basically betting on, they were packaging these options up to say, here's a bunch of loans, and because the US housing market is so strong, it's going to keep going up in value. This is like a sure investment, top quality, AAA rated investment. It's not going to fail. And they packaged all these up into mortgage-backed securities, sold it to investors. And this was like pension funds, mum and dad investors. And then the whole market collapsed and everyone just lost all their money. And I guess we can see the oil price going into negative. That kind of reflects this as well, like what can happen if things go wrong. Because if you, say, bought oil to take delivery and the price went to negative.
How does the price of something go to negative? How does that work?
So the contract is to take physical possession of the oil.
And then therefore it costs money to store the oil?
Yeah.
Right, and that's where the negative comes in.
So if you're like a trader in New York and you trade these derivatives, you probably don't want to take delivery of 10,000 barrels of oil or how many oil. You probably can't physically do that. So what happened in that situation is so many people had contracts open that they wanted to get rid of because they couldn't take delivery of oil, that the market said, wow, we've got all this extra oil in supply. We need to deliver it and drop it off places. So you have to pay us to take your oil because you said 2 months ago that you wanted to take delivery of this oil for that price on the day.
Right.
And now you've got nowhere to store it. So we'll keep the oil, but you have to pay us for it.
Wow. So it's people who that's the issue, right? Because it's people who have no intention of buying the product at all. They're just speculating, and their sole existence is to make profit on the difference.
Exactly. So they're using these, which in theory could be very useful for a supply chain to have certainty over the cost on an ongoing basis.
Mm-hmm.
And then becomes like a token value because it's just being traded without any intent of actually taking delivery of the goods.
Yeah. How wild. Yeah. And it just, I think that's where people start making the argument of kind of capitalism's gone a bit haywire.
Yeah.
You know, where it's like people's sole existence, and they operate in a world of money, and its sole existence is to make more money on money. Thank you for watching that clip. If you enjoyed it, make sure you hit that subscribe button on the left. And if you want to watch the full episode, hit the square on the bottom. To watch another small clip, go ahead and hit that square on top. And if you just want to listen to the full episode but don't have time to watch it, you can find this podcast wherever podcasts are listened to. Thanks. Bye.